Imagine running a fully legal business, paying taxes, following every rule, and one morning your bank account is simply gone. No court order, no explanation, just a letter saying your account has been closed. This isn't a hypothetical. Between 2021 and 2024, it happened to more than 30 founders across the crypto and tech industry. And for years, banks and regulators denied it was happening at all. Here's the part that makes this different from every other banking conspiracy video you've seen. This one is proven. In November 2025, the House Financial Services Committee released a formal report built on leaked FDIC letters, Federal Reserve supervisory guidance, and sworn testimony, confirming that federal regulators quietly pressured banks to cut ties with entire industries using a vague, undefined term, reputational risk. No law was passed, no hearing was held, just informal pressure applied behind closed doors, powerful enough to end companies and freeze people out of the financial system entirely. And crypto wasn't the only target. Gun retailers, fossil fuel companies, and politically disfavored individuals have all pointed to the same pattern. For years, when people raised this, they were told it was paranoia, a conspiracy theory. Banks don't work that way. Then the paperwork came out. FOIA requests, leaked supervisory letters, sworn testimony from bank CEOs describing the exact same experience, independently years apart. Over the next few minutes, I'm going to walk you through exactly what happened, who did it, how it finally came to light, and just as important, what actually changed in 2025 and 2026 to stop it. Because unlike most wealth trap videos, this story already has an ending, and it's not the one you'd expect. No gold bars, no opt-out blueprint, just documented policy, documented harm, and a documented fix, which, if you run a business or manage money in this economy, is actually more useful to know than another prediction about what might happen next. Let's get into it. The term sounds abstract until you see how it actually works. It starts with a regulatory concept called reputational risk. The idea that a bank could face public backlash simply for serving a certain type of customer. Regulators never needed to write a law saying an industry was illegal. They just needed to signal, informally, that banks serving that industry would face extra scrutiny. Banks, wanting to avoid that scrutiny, simply stopped serving the industry altogether. This isn't new. It started under the Obama administration with the original Operation Choke Point, which pressured banks to cut off payday lenders, gun shops, and tobacco retailers. But what happened between 2021 and 2024, now widely referred to as Operation Choke Point 2.0, was documented in far more detail. Through Freedom of Information Act requests, Coinbase and other firms obtained FDIC letters showing at least 23 instances where regional offices told banks to pause or not proceed with crypto-related activity. The Federal Reserve issued its own supervisory letters requiring banks to get pre-approval before touching anything crypto-related. The human cost was real. Venture capitalist Mark Andreessen said publicly that more than 30 tech founders have been debanked over 4 years, some losing access to payroll accounts, some having personal accounts closed with no reason given. Custodia Bank, a federally chartered institution built specifically to serve crypto clients legally, was denied a Federal Reserve master account and had to sue. This wasn't a rumor circulating on social media. It became sworn congressional testimony. At a February 2025 House hearing specifically dedicated to this issue, one witness, the CEO of a digital payments company, put it bluntly, regulators had effectively decided that because some bad actors existed in an industry, the entire industry should be cut off from basic banking. Not loans, not credit lines, just ordinary checking accounts needed to pay rent and payroll. Anchorage Digital, a federally chartered national bank regulated at the same level as JP Morgan Chase and Wells Fargo, described losing a trading relationship worth hundreds of millions of dollars a month, along with having individual employees personally debanked. This is what made the story different from a typical online rumor. It wasn't just founders complaining. It was federally chartered, fully licensed institutions describing the same pattern under oath. And this is worth pausing on. 3 of the banks most closely tied to serving crypto clients, Silvergate, Signature, and Silicon Valley Bank, all failed within the same several-day window in March 2023. The House Committee's report specifically ties the regulatory pressure campaign to the stress those banks were under, arguing that cutting off a legal, growing customer base from stable banking relationships didn't just harm individual founders. It may have contributed to instability in the banks that served them. This is the part most 2026 wealth trap. Content gets completely backwards, so let's be precise about it. A central bank digital currency, or CBDC, would be a digital dollar issued directly by the Federal Reserve, different from the digital money you already use through a debit card, because a CBDC could theoretically be programmed with rules, an expiration date, spending restrictions, geographic limits. That possibility is exactly why privacy advocates across the political spectrum raised alarms about it for years. Here's what actually happened next. In January 2025, President Trump signed Executive Order 14178, explicitly banning federal agencies from creating, issuing, or even piloting a CBDC. Then, in June 2026, Congress went further, passing legislation that codifies a CBDC ban into law through 2030. Federal Reserve officials have said publicly multiple times that a U.S. digital dollar is not in development. So if a video tells you a programmable digital dollar is quietly rolling out in the U.S. right now, that claim is not just unproven, it's the opposite of the documented current legal reality. The CBDC fear was real enough to generate a genuine policy debate, and that debate ended with the idea being banned, not built. It's worth understanding why the fear existed in the first place, because the underlying concern wasn't irrational. It was about control, not currency. Privacy researchers pointed to pilot CBDC programs in other countries, some of which did include spending restrictions or expiration windows on stimulus-style disbursements, as a preview of what a poorly designed digital dollar could look like. That's a legitimate policy conversation. What turned it into misinformation was skipping the pilot programs elsewhere, hypothetical risk framing, and presenting it instead as an already locked-in outcome for the United States specifically, which the actual legislative record simply doesn't support. While the CBDC story got banned before it started, a quieter, more concrete version of banks judging you for what you do has actually been playing out at the state level for years. Several major U.S. banks came under pressure to reduce lending to fossil fuel, firearms, and agriculture companies as part of ESG, environmental, social, and governance investment standards. In response, at least 18 states passed or proposed anti-ESG laws restricting this kind of practice. Texas banned municipalities from banking with institutions seen as boycotting fossil fuels or firearms. When major underwriters left the state rather than comply, researchers found it cost Texas taxpayers between $300 and $530 million in extra borrowing costs over just 8 months. Here's the detail that matters most for this story. Utah passed a law that explicitly prohibits financial institutions from denying a customer transaction based on social credit score, political views, or protected class status. That's not a talking point. It's real statutory language, passed because lawmakers were responding to genuine documented cases of banks and payment processors declining service based on a customer's industry or public statements, not their actual creditworthiness. This is the real version of the social credit fear, not a secret government program, but a documented pattern of financial institutions making case-by-case judgment calls that state legislatures have now moved to restrict. By early 2026, roughly 18 states have proposed or passed some version of these anti-boycott and anti-discrimination banking laws, with growing numbers specifically borrowing Utah's no denial based on social credit score language. Not every one of these laws has survived legal challenge. A Texas court struck down part of that state's fossil fuel banking law in February 2026 on First Amendment grounds. And the fight over how far a state can regulate a private bank's lending decisions is still working through the courts. But the underlying pattern these laws respond to is documented, not speculative. Banks really were making case-by-case decisions to deny services based on industry and political exposure rather than pure financial risk. And lawmakers on both sides of the aisle have pushed back on it in different ways. Unlike most financial trap stories, this one has a documented resolution already in motion. In March 2025, the OCC announced a major shift. The Office of the Comptroller of the Currency said it would no longer examine banks based on reputational risk at all, removing the tool used to pressure banks into debanking entire industries. The Federal Reserve withdrew its crypto-related supervisory letters and, alongside the FDIC and OCC, issued a joint statement in mid-2025 walking back blanket warnings about serving crypto clients. Then in August 2025, President Trump signed Executive Order 14331, guaranteeing fair banking for all Americans. It directed regulators to stop using vague, subjective standards to pressure banks into cutting off legal customers and to investigate past cases where it happened. The House Financial Services Committee's November 2025 report documented exactly how the practice worked, agency by agency, letter by letter. This is the part worth sitting with. A practice dismissed as a conspiracy theory, for years turned out to be real, documented with government paperwork, and then formally reversed through an executive order and regulatory guidance. All within about 18 months. That's a rare thing in finance content. An ending, not just a warning. The OCC's acting comptroller said banks will be judged on transparent, objective risk factors instead of subjective public perception concerns. A meaningful structural change, not just a press release. The House committee also committed to investigating whether the largest banks engage in unlawful debanking beyond regulator pressure, meaning accountability is still active into 2026, not closed. So here's the practical version, without the fear-mongering. First, don't concentrate all your banking relationships in one institution, especially if you run a business in an industry that's ever been politically contentious: crypto, firearms, cannabis, adult content, even certain political or advocacy work. This isn't about hiding from a secret system. It's ordinary business continuity planning. The same logic as not having only one client or one supplier. Second, know that you now have a documented federal policy on your side. Executive Order 14331 exists specifically to prevent the kind of informal debanking pressure we just walked through. If you ever believe you've lost access to banking services for reasons unrelated to your actual financial risk, that EO and the House Committee's public report are real documents you can reference. Third, separate documented history from ongoing speculation. The debanking story is real and finished its first major chapter. Claims about a 2026 social credit rollout or an active CBDC program are not supported by current policy. Treat any content making those specific claims with real skepticism and check primary sources like Congress.gov, Federal Register executive orders, or official Fed statements before acting on them financially. Fourth, if you're building a channel or business around finance content, this story is also a lesson in sourcing. Notice the difference between how this video and a typical wealth trap video handle the same underlying anxiety. Same emotional starting point. The fear of losing access to your own money for reasons outside your control. But one version invents a fictional 2026 rollout, and the other points you to an actual House Committee report you can read yourself. The second version builds more durable trust with an audience, even if it takes more work to produce. The real lesson of this story isn't the system is secretly controlling you. It's that opaque, subjective regulatory power, even without a formal law, can genuinely affect ordinary people and legal businesses. That's worth understanding clearly with real sources, instead of folding it into a vaguer, scarier story that isn't actually true. That's the real Wealth Compass approach. Not the scariest possible story, but the one you can actually verify. Because the version you can verify is the one that should actually change how you plan.